Evening, welcome. Please take your seats. Thank you for coming. I am Sebastian Burke. I'm the Director of Corporate Programs at the Chicago Council on Global Affairs. We are thrilled to have a great audience tonight to welcome Governor Jerome Powell to our platform as part of our Food, Fuel, and Finance series. I would also like to thank the CME Group for their continued support of this important series at the Council. As you may know, the Chicago Council on Global Affairs is an independent, nonpartisan organization that convenes leading global voices, engages the public, and conducts independent research to provide insight and influence the public discourse on critical global issues. For nearly a century, the Council has provided a platform for a variety of different voices to promote deeper global understanding and active U.S. engagement in the world. The views of individuals expressed on these platforms, including our website, are their own, and they do not represent institutional positions or views of the Chicago Council on Global Affairs, its members, or its supporters. Before we begin, a few housekeeping items. Please know that this event is on the record, so feel free to use social media, and we are also live streaming. Also, please remember to silence your phones. This is the last program of our spring season, and we look forward to seeing all of you in the fall for an exciting new lineup. I will return to the stage to moderate the Q&A, but before, I'd like to welcome to the stage to introduce our speaker, Mr. Leo Melamed. He is Chairman and CEO of Melamed & Associates, Chairman Emeritus of the CME Group, and a valued member of our board of directors. So please join me in welcoming Mr. Leo Melamed.
Thank you, Sebastian, and good evening to everyone. Thank you for joining us in this seminar. We at the Merck have been members of the Council for many years, and we try to provide the Council with some interesting ideas. The last programs we had, some of you may have attended, where we had talks by three Nobel laureates, Myron Scholes, Bob Merton, and Bob Schiller, and they provided us with the insights to their thinking of issues that we face in the world. And of course today, this is the new program. Actually, it's the second part of the CME's new program. The first one, it was called Food, Fuel, and Finance. But this is the second one, and it's the finance part. And let me tell you that we were all set to go with the fuel thing when it all exploded, or rather fell apart. And the gentleman that was going to speak on this issue was not able to come from Saudi Arabia, so we decided to shift gears to the finance part first. We'll have the fuel topic sometime later this year. Food, finance, and fuel is, of course, what the Merck does. We started in agriculture, all of you know, butter and eggs, later pork bellies and cattle. And then suddenly, in the early 70s, we turned to finance with the launch of currency futures, and then interest rate futures, and then stock index futures. And of course, the finance took over our lives, and today we're like 90% finance. But then in 2007 and 2008, we expanded, and we took over the NYMEX in New York, which gave us an energy component. So today, and of course the Chicago Board of Trade is grain markets, and today the CME is, of course, the largest financial institution of its kind in the world. And we take our work very seriously. I think we've done very, very well over the years, coming from a little butter and egg institution that we were. when I was just born. And so we are delighted and honored to be able to present Governor Jerome Powell as our main speaker today. And we were worried that the subject of finance that he was going to talk to us as a member of the Fed might be boring. So what we did is execute Brexit. That way we figured he'd have something to talk about in case. But actually, we at the Merck have gotten to know Jerome Powell in a substantive way, because what he does at the Fed, and he was appointed only a couple of years ago, and he's going to be around for another 14 years. And fortunately for us, he comes really primarily from the private sector. So this isn't just another bureaucrat that got appointed. This is somebody that really knows his stuff. And as a result of that, he's doing some major things at the Fed. 3 items that he is concentrating on concern the system of repo rates, how to handle the potential illiquidity that might occur during a crisis, as it almost did or did in 2008. And so the issue of repo rates is on his agenda, as is the issue of the LIBOR rates. You all have read and know that the LIBOR used to be the reference rate and was an accepted reference rate for many, many years of the 90-day interest rate benchmark. But things didn't turn out so well for that. And so on his desk was placed the issue of LIBOR and how to get a reference rate that everybody can trust and everybody can look at and know with certainty that it has the credibility it deserves. And the third topic is really his agenda as well, and that has to do with the quickening of the world, really. You know, technology has changed everything in our lives every day, almost. And most of you know what the world we left was much slower, and now it's much faster. And record keeping is a big issue now. You know, it used to be you can write the record, the ledger is right there, I'll get to it in a month, a week, a day. You can't do that anymore. Those records affect everything we do, and the consequence of clearing those records has to be done in a modern way with modern technology. Blockchain comes to my mind, but there's hundreds of other ways. In fact, the CME has agreed with a university in London, the word escapes me, to do research on blockchain, Cambridge, to do research on blockchain and the new technologies that deserve to be absorbed and used, and again, to change our world. That's the third topic that is on his agenda, among the other things that a Federal Reserve governor does. So, without further ado, I want to tell you that this gentleman is doing a great service to this nation, a most important service to this nation that has really very little to do with just Brexit. It has to do with the economy and the system that we have that has to be the strongest in the world. Governor Jerome Powell.
Thanks very much, Leo. It's a pleasure to be introduced by you and an honor to be introduced by you. Also happy to see Mike Moscow here, the former president of the Chicago Fed, is somewhere out there. And there you are, sorry. Hiding in plain sight. And I just want to say that the Chicago Fed is a great institution within the Federal Reserve System. I'm a big believer in our unique federated system, unlike any other in the world, and it really is a way that the Federal Reserve has, the way it's created, has institutionalized a diversity of viewpoints. We have 12 reserve banks around the country, and it's an odd structure, it's a unique structure, but my experience, a little more than 4 years at the board, is that it works. And the Chicago Fed is sort of the living example of how good it can be. So it's great to be here today. The council has been a thought leader here for nearly a century, encouraging public discourse, education, and research on important global issues. And your global focus is particularly important for understanding the challenges facing the United States economy today, as shown by last week's referendum on the United Kingdom's status in the European Union. And I'll return to that in a few minutes. In my remarks, I'm going to do two things. First, I'm going to review recent economic developments and the outlook for the economy. And then I'd like to turn and discuss an issue that I think really deserves much more discussion than it gets in our public dialogue, and that is the longer-term productive potential of the economy. We talk a lot about, will the Fed raise interest rates now or later, and it's all very, hi Desiree, my old friend from the Bush Treasury Department, Desiree Tucker-Serini, right there. We talk a lot about the short-term things that the Fed might do, but we don't focus enough on the longer-term issues of U.S. growth and the things that we can do as a people to strengthen longer-term growth. So where to start, a good place to start is the dual mandate and the state of the economy. As you know, the Federal Reserve, through the Federal Open Market Committee, is charged by Congress with achieving maximum employment and stable prices. And those are the actual words in the statute. We call that the dual mandate. For price stability, we've adopted a goal of 2% inflation, and that's as measured by the annual change in the price index for personal consumption expenditures. Everyone knows the CPI number. That tends to be about 0.5% higher. So at some point in history, the Fed, I'm sure Mike could give you the history, the Fed chose to target this other inflation, which is measured a little bit differently, but tends to be between 35 and 50 basis points lower. But that's what we've targeted. Many other central banks around the world have also targeted 2% inflation. We have not set a numerical goal for maximum employment, and that's because the longer-run sustainable level of employment is determined mainly by non-monetary factors that are outside the Fed's control, things like demographics, social change, and fiscal and regulatory policies. But 4 times a year, FOMC participants write down their estimates of the longer-run sustainable level of unemployment, what we call the natural rate of unemployment. And at the recent June FOMC meeting, the median estimate of that rate was 4.8%. So how should we evaluate our performance? What grade should we give ourselves against the dual mandate? So I would say that we've made substantial progress toward maximum employment, and I'll get into more detail on that, although I also think there's room for improvement there. I also think, though, that we have more work to do to assure that inflation does get back up to our 2% goal. We're not used to thinking of inflation as being too low, but that really is the situation you're seeing here and far more so all around the world. So let's talk for a minute about the employment mandate. After several years of strong job growth, really starting in 2013, we had a little more than 3 years so far of very strong job growth. We now have employment, which is 5 million higher than the pre-crisis peak in 2007. 5 million more people are working than were at the pre-crisis peak. And the unemployment rate has fallen from 10% in 2009 to 4.7% in May, which is right at estimates of the natural rate. Now, the natural rate sounds like a scientific thing, and it sort of is, but it's far from being a bright line. You can't observe it directly. It exists as an estimate, and estimates of basically everything in economics are subject to great uncertainty, including this. So we look to a wide range of labor market indicators to assess the overall health of the labor market. And many of those indicators suggest that the labor market is healthy and strong. To mention just a couple of those, the level of job openings is at an all-time high, according to one particular measure. And that's just, the idea being that employers are looking for people. The quits rate is also back to a pre-crisis normal level. So the fact that people are willing to quit their jobs is a very positive signal. Also, we survey, other people survey individuals and businesses, and those surveys suggest that the ease of finding and filling jobs is similar to that experienced in mid-2000s. So even though we're near the natural rate of unemployment, there's still room for improvement along several margins, and I'll discuss a couple of them. Important among these, and I'll start with this, is the labor force participation rate. So participation in this context means that you're either employed or it means that you're actively engaging in looking for a job. If you drop out of the labor force for any reason, even temporarily, you're not counted as unemployed. So the labor force participation actually is a key determinant of the unemployment rate. So one way to think about it is, imagine a labor force of 5 people in which 4 of them have jobs and 1 is unemployed. The unemployment rate is 20%. If that person who's unemployed then says, I can't do this anymore, and drops out of the labor force, the unemployment rate goes to 0. So it is, in fact, an important determinant of this. Labor force participation is influenced by many factors, including the age structure of the population and individuals' perceptions of the availability of jobs. So participation, it's a big issue right now, which is why I'm going to spend a minute on it. Participation rose steadily from the 1970s through the 1990s as increasing numbers of women entered the formal labor market. But that process eventually ran its course, and around the year 2000, participation peaked and began a gradual decline because of population and the continuation of other longer-run trends, one of which is that prime-age males are gradually working less and less as part of the labor force. It's a long-run trend. From 2008 to 2013, participation dropped sharply by 3 full percentage points, and then it remained flat since late 2013 in a context of strong job growth and declining unemployment. So economists estimate that as population ages and other trends go on, the participation will decline at a rate of about 0.2 per year. So the fact that we've been able to hold participation constant now for almost 3 years, in fact, represents a gain against trend, and it means we're working off some of that cyclical drop, very large cyclical drop that we had at the end of the crisis. So participation, labor force participation today is near its longer run trend, as a very well-known group of Fed economists whose work is widely cited on these issues would say. There are other estimates, though, that say that there's still a shortfall, and in other words, that there are people sitting around the edges of the labor force that would like to work, but they're not participating. And I'm actually inclined to believe that. We probably all know people in our lives who would come back to work, and I certainly do. I have relatives who would come back to work in a tight labor market where wages were increasing and employers were trying to hire and labor was in short supply. So my view would be that we can go higher in participation, and I'd like to see that. One reason I would like to see that for sure is that the U.S. participation rate for workers in the 25 to 54 age group, the prime age group, our own participation is now below that of almost all other advanced economies, including the United Kingdom, France, and Germany. That was not the case before the crisis. So this is not a good fact, and so I want to believe that we can get higher than we are now. In addition, there's a statistic around the number of part-time workers who want full-time work, and that remains above pre-crisis levels, which also suggests that there's some remaining slack. The final thing I'll point to is that wages have been very weak, haven't been growing. You're just starting to see a welcome pickup in wages, and that suggests that the labor market is tightening, but is not yet tight. Let me turn to recent developments for a minute. So that was all, I would say that's a pretty good picture of where we were in the first quarter of this year. But recent data have actually been sending mixed signals on the level of momentum in the economy. Business investment has weakened, and that's true not just in the energy sector, where you would expect investment to be very low because oil prices are so much lower, there's much less drilling going on. But it's also weak in non-energy related businesses. And GDP has actually slowed to a rate of about 1.25% for the fourth quarter of last year, first quarter of this year. So this is a slowing of activity that's pretty broadly felt, although the current quarter looks better than that. The labor market data, though, the thing that we've really been able to feel good about for 3 years now has been payroll job growth of more than 200,000 a month. And when you have that going on, you can look through the very volatile quarterly readings on GDP, because quarterly GDP moves all over the place, and it's incredibly difficult to measure the output of an economy the size of the United States. It's just very, very hard to do it. So you have to look at longer run averages to really know. So that's why it's a little bit disturbing that in April and May, for the first time in 3 years, payroll numbers came in really low. So this, you don't want to overread, I wouldn't want to overread and make too much of 2 monthly payroll reports, because like every other data series, there's a lot of noise in that. But it is concerning. The possible loss of momentum in the job market is worrisome. Now, this question of how much momentum there was in the economy, this was very much the question lingering in the air before the Brexit vote. But before we get to that, let me talk about inflation for a second. So, again, I told you what our preferred measure of inflation is. It's been running below 2% ever since the financial crisis, except for the Arab Spring period in 2011, which, if you recall, oil prices spiked temporarily, and that passed through the economy. But underlying inflation, core inflation, has been below objective for several years now. In fact, for the last 12 months, in total inflation, headline inflation is only 1%. And core inflation, which, as I'm sure you know, excludes food and energy prices, was about 1.5%. Some of that is that core inflation is held down by falling import prices, which are a function of a lower dollar, as well as indirect effects of lower oil prices. So if the dollar and oil prices remain broadly stable going forward, inflation should move over time to our objective. So when I first was exposed to economics in college, it happens to be 45 years ago this fall, I learned that inflation was strongly influenced by the amount of slack in the economy. Think about the Phillips curve, which, if you took college economics, it's the relationship that says that when unemployment is really high, inflation is low, and when inflation is high, unemployment is low, and the labor market is tight. So this was the Phillips curve relationship. And that relationship really disappeared almost over time, so that slack no longer has much effect on inflation. In addition, inflation, we now believe, depends importantly on the expectations. More importantly than on slack, it depends on the expectations of workers and firms. It is no longer particularly affected by the business cycle. So we measure inflation expectations in two ways: through surveys of households and also through surveys of forecasters. And also, we look at market readings. There are inflation swaps in the market, and there are things called break-evens. I can go into detail if anybody wants to ask about that. And what's happened is, since the middle of 2014, market-based measures of inflation have really gone down to all-time lows. Now, survey measures, we've been able to comfort ourselves, have remained stable. And remember, inflation expectations are really key. We believe they are really key in holding inflation, in preventing inflation from going down even further than it is. So it's important that inflation expectations remain stable. Now, some surveys have started to weaken. And so, given the importance of inflation expectations in our thinking, these developments deserve, and they get, very careful attention. And while inflation expectations seem to me to be reasonably well anchored, it's essential that they remain so. And the only way that they will remain so is if we actually achieve inflation of 2% and keep it there. So I'm strongly committed to that objective. Let me look ahead for a second then. My belief, my baseline forecast for the economy has been for some time that it's likely to continue on a path of growth around 2%. I also expect and have continued to expect that labor markets will continue to create jobs at a faster pace than the labor force grows, and that healing will continue. We'll get wage increases and such, and that inflation will move up over time to the committee's 2% objective. That's been my expectation and many people's expectation, frankly, for a long time. And for some time, the principal risks to that outlook have been from abroad, not really from the United States economy domestically. Global economic and financial conditions are particularly important for our economy at the moment. Weakness in economic activity around the world and related bouts of financial volatility have weighed on the performance of our economy, and you see that in the last 2 weak quarters. Given the stronger performance of the U.S. economy, the trade-weighted value of the dollar has risen 20% since the middle of 2014, and such a large appreciation of the dollar means that we're effectively exporting our strength and importing the global weakness around the world. Growth and inflation remain stubbornly low for most of our major trading partners. European and Japanese authorities have limited scope to respond because they've got daunting longer-run fiscal challenges, and their policy rates are already set, in many cases, below zero. In China, stimulus measures that they've enacted should support growth in the near term, but they may also slow China's necessary transition away from its export and investment-led business model. In addition, emerging nations are facing a range of difficulties, including particularly such nations as Brazil, Russia, and Venezuela. So these global risks have now shifted even further to the downside with last week's referendum. The Brexit vote has the potential to create new headwinds for economies around the world, and that includes us. The risks to the global outlook were already somewhat elevated prior to the referendum, and the vote has introduced new uncertainties. We issued a statement last Friday saying that the Federal Reserve is carefully monitoring developments in global financial markets in cooperation with other central banks, and that we're prepared to provide dollar liquidity through our existing swap lines with central banks as necessary to address pressures in global funding markets, which could have adverse implications for our economy. I would say, as of now, although financial conditions have tightened since the vote, markets have been functioning in an orderly manner. I'd also point out that the U.S. financial sector is strong and resilient, and that as our recent stress tests, you may have seen, show, our largest financial institutions continue to build their capital and strengthen their balance sheets. It's far too early to judge the effects of the Brexit vote. As the global outlook evolves, it will be important to assess the implications for the U.S. economy and for the stance of policy appropriate to foster continued progress toward our dual mandate. I'm often asked, and all of us are often asked, why rates remain so low now that we're near full employment. And a big part of the answer is that, at least for the time being, the appropriate level of rates is simply lower than it was before the crisis. As a result, policy is really not as stimulated as it might appear to be. So estimates of the real interest rate, i.e. the actual rate minus inflation, estimates of the real interest rate needed to keep the economy on an even keel if it were operating at maximum employment and 2% inflation. And this is what we call the neutral rate of interest. Estimates are that the neutral rate is currently around zero. It would have been estimated at around 2%. So rates need to be fully 2% lower than they would have been at an equivalent point in the cycle before. Now, I would anticipate, and others do, that the neutral rate will move back up over time, probably not all the way back to where it would have been before the crisis, as some of these headwinds that have weighed on economic growth ease. And that really wraps up the comments I wanted to make on the cyclical position of the economy and the questions that exist about momentum and our international risks. And what I'd like to do is take a step back from this current context and explore the issue that I mentioned earlier, the longer run potential growth rate of our economy. So one reason that the neutral rate of interest is so low is that potential growth appears to have slowed. Since the crisis ended, forecasters have broadly reduced their estimates of the ability of the United States economy to grow on a sustainable basis from 3% to about 2%. So a full percent reduction, which is a seemingly modest amount, but it actually implies dramatically smaller increases in living standards over time. And there's a growing body of research that shows that deep recessions accompanied by severe financial crises often leave behind permanent damage behind them. One recent analysis, for example, suggests that in about a third of the cases after a severe financial crisis, there isn't any permanent damage. In another third of the time, there's a permanent reduction in the level of potential output, but the growth rate will return to its earlier growth rate. And then in the third third, there's a reduction both in the level of output from the recession, but there's also a slower growth rate going forward. And unfortunately, many economies around the world look like they're falling into that third category, and that includes our economy as well. So you can think of output growth, these are economic terms, but really just what it is how many hours do you work and how productive are you in those hours? That's really what it breaks down into. And most of the decline in the in U.S. potential growth is estimated to be in productivity. It's not in fewer hours. It's just that the ability to produce more year upon year upon year for every hour worked has been marked down significantly. Labor productivity growth began to slow around 2005 before the financial crisis and has been only 0.5% per year since 2011, which is the slowest 5 years of productivity growth since World War II. Not a good record. And that the productivity slowdown has been worldwide and has been seen in countries that weren't even that strongly affected by the financial crisis. So it's interesting. You see these things happen and you want to think of them as caused by U.S. specific factors, but in many, many cases, they're not. There are global forces that are driving these things, including this one. Increasing productivity is essential if living standards are going to continue to rise over the generations. So that raises two questions. One is, why has productivity been so low? And the second is this the new normal? What's it going to be in the future? So we actually have tentative answers to the first question, the question of why it's been so low. So labor productivity really just is, it's the skills of the labor force and the tools that they have. And then the third thing is, how well do firms do given those two inputs? So it's really just those three things. It's the labor force and their skills, and then it's the tools they have, and then there's a kind of component that's not accounted for by those inputs, but the ability to make them work better together is the third thing, and that's actually called total factor productivity. So in our case, the weak performance of the productivity since the crisis appears to be mainly from weak business investment. So business investment's been very, very weak, and also from that third factor, low TFP growth, which we understand less well. Weak business investment, in some sense, makes sense because of weak demand and also uncertainty about risk aversion after the crisis, and companies have been reluctant to invest. So that kind of makes some sense. TFP, or total factor productivity, is equally important. It actually generally accounts for most of the difference in productivity over time, but we don't understand it particularly well. We can talk more about this if people are interested. So the second question, what's going to happen to productivity going forward, is the subject of an intense and, I think, from my perspective, fascinating debate. The range of forecasts about potential growth and how fast can the U.S. economy grow is wide, and the historical record provides ample grounds for humility. It's very difficult to forecast this. Some of you, many of you may be carrying around, when you go to the lake this summer, this being the Midwest, I would say the beach if this were in Washington or New York, you may be carrying Robert Gordon's massive The Rise and Fall of American Growth around, which is this new book. It's probably the best-selling economics book of the last several years, which takes the pessimistic point of view. If you do take that to the lake, then you should also bring along a book called The Second Machine Age by Brynjolfsson and McAfee, which takes a much more sort of techno-optimist view and is also quite a bit shorter, which is a good thing for a summer book. I want to turn to one factor that may contribute to low productivity that doesn't get discussed much yet, but I think will, and that is the notable decline in recent decades in measures of dynamism in our economy. And dynamism has a particular meaning in this context. So entrepreneurs start new firms. Most of them fail, but a few of them succeed, and those grow very rapidly, and they account for significant amounts of job formation. Older firms shrink or they go out of business if they fail to keep up with innovation and advances in productivity. Workers change jobs, they move around the country or around the world as their careers evolve and as companies grow and shrink. So these processes can be painful and they can be messy for both workers and firms, but they are essential to the process of allocating resources to their highest and most productive uses. The high levels of innovation and fluidity of our economy have long been thought to be among the principal reasons for our high and rising living standards. So essentially all of these processes have slowed down dramatically over the past few decades, and that is seen in declining rates of creation and destruction of both firms and jobs. So let me take startups to begin with. Startups are a key driver of productivity growth. And although it certainly feels to me as though we're living in this age of disruption where new companies are coming along, in fact, the birth rate of startups has been declining for 4 decades. You can loosely group new firms into two categories. The first is you could call lifestyle entrepreneurs who really want to be their own boss, but they don't really shoot for a little prospect, or they don't really have much prospect or desire for really high growth. The second is those that are founded by transformational entrepreneurs who set out to grow dramatically and change their industry. So for the first, think of someone who starts a bookstore, let's say, and it's just a bookstore. It's not going to be a big chain. It's just a nice living and wants to keep life simple and play golf 3 times a week. And for the latter, think Amazon. So before 2000, the decline in startups was mainly of the first sort. Since 2000, it's also found among the so-called transformational firms. And while the drop in formation of lifestyle firms could be neutral or even a positive for productivity, as it sort of has been in the case of the U.S. retail sector, the reduction in the creation of high-performance new firms suggests that lower dynamism could be associated with slower productivity growth. Let me look at labor market dynamism, which is just jobs. So while changing jobs can be painful, job changes in the aggregate are associated with higher pay, higher compensation, which implies higher productivity. But the rewards to job change may have declined over time. It looks like they have. Fewer startups has meant lower job flows as measured by job creation and destruction, and fewer opportunities for workers to find better jobs. Labor market dynamism across many dimensions has declined, and by more so than would be explained by the reduction in startups. Workers are simply becoming less likely to leave their jobs, less likely to change jobs, less likely to move geographically to take new jobs. Now, dynamism is a new field of inquiry relatively, and there isn't any consensus yet on the reasons for or really the implications of these developments. Some of the plausible sources of these changes are benign. Maybe companies and workers are better at matching up in the first place. But other explanations are more negative and suggest that the reduction in dynamism may be a factor behind these slower increases in productivity. For example, historically there's been a strong correlation at the firm level between productivity and growth. That relationship has weakened. So now high productivity firms are not growing as quickly, and low productivity firms are shrinking or exiting at a lower pace. Now, the point of this is, it may be that some government policies, while well-intended, have contributed to these trends. One example that may explain probably a small portion of this trend is the substantial increase in occupational licensing. By some estimates, the fraction of workers who are required to hold a government license or certification to perform their jobs has risen from 5% in the 1950s to close to 40% today. Like many policy, licensing has benefits and costs. So the costs are, of course, it can tend to reduce job switching, and it can limit opportunities for employment for excluded workers. It may also restrict competition and raise prices for consumers. Of course, the benefits are higher quality products and services and improved health and safety standards. I assume we could all agree that we'd prefer to have the pilot in our airplane have a license, for example. But some researchers have advanced the view that licensing requirements have gone too far and have become overly burdensome and may have contributed to the secular decline in job and worker movement. And if you read some of those papers, I think it feels to me like there may well be something there. So this is a fast developing field of research, and it's going to be important that public policy react appropriately as this work continues and as answers are found. In fact, more broadly, it goes without saying, or in any case should, that economic policymakers should use all available information and tools to create a supportive environment for growth. We need policies that support labor force participation and the development of skills, business hiring and investment, and productivity growth. I hasten to add, most of these policies are outside the remit of the Federal Reserve, but monetary policy can contribute by supporting a strong and durable expansion in a context of price stability. So to conclude, let me ask the question, how should we think about the performance of our economy since the crisis? It's a mixed picture, and there's no question that this will be debated down the decades. But let me leave you with some facts. First, since 2011, really, job growth has been stronger and unemployment has declined faster than most forecasts. Paradoxically, on the other hand, economic growth, by which I mean GDP growth, has been consistently lower than almost all private and public sector forecasts, including just about any economist you can name, and certainly including FOMC participants. Growth has been slower in this recovery than in many previous recoveries. That is true in the United States and all around the world. A growing body of research shows that weak recoveries are the norm after deep recessions, particularly those associated with severe financial crises. Finally, though, our recovery has been stronger than those of many other advanced economies after this crisis. As I said, it's a mixed picture. You can pick whichever of those data points fits your view. So I will now wrap up and just say that I do expect that our economy will continue to make progress. I think that monetary policy will need to remain supportive of growth as we work through this very challenging global environment. And as always, it will be important to carefully monitor economic developments in order to assess what the stance of policy should be to foster progress toward our dual objectives of maximum employment and price stability. Thank you very much, and I'll be glad to take some questions.
If you have a question, please raise your hand and I will call on you. Please wait for the microphone and please make sure your question is a question and not a comment. Okay, we have one question on that side, please.
Thank you, and it's an honor to have you here, Jerome, with us today. I have a question regarding the productivity. You think that the acceleration in productivity might be related to the debt levels that we see in the US and around the world? And as an example, meaning that since education is so expensive and students have become highly indebted in order to pay for it, they might be more risk averse, meaning that they would be more wary of taking other jobs or being entrepreneurs if they know that they have to pay off their student debt. And as a product, might this have affected productivity? Thank you.
So I think a direct answer to your question is no, I do not think that those are particularly important factors as it relates to productivity. I wouldn't want to say that I think that our particular approach to student debt is a wise one or a good one. This is a growing problem in our economy. We're over $1 trillion in student debt, and by the way, if you go bankrupt, you can discharge your debt in bankruptcy, unless it's a student loan. We single that out for not being able to be resolved. If you go to the trouble to invest in your future, that we don't forgive.
Okay, second row in the front, right here. Yes, yep, microphone's coming.
This is a little bit off your subject, but are you familiar with this chart on the back on the program sheet titled Expected Short-Term Interest Rates? It says that the Fed expects the short-term interest rates to go to 3% by 2019. Do you agree with that? And what is your thinking?
So I don't have that chart in front of me. I could probably answer your question without looking at it, but let me look at it first. Just give me a second. Okay. So what this is I believe what this is the, so 4 times a year, as I mentioned, all 17 FOMC participants write down their forecast for the next 3 years, and then they write down what they think appropriate monetary policy is. And this represents conditional on that path for the economy. And what this represents is the median estimate of that group. It's not really a forecast of interest rates. It's the median estimate within that group. So, and it depends on the realization of the forecast. So, that's really what it is. I wouldn't say that I believe that that's what will happen. That's not really the sense of it. It's more like that's appropriate monetary policy, assuming a certain set of objectives is achieved. I think the other thing I'll say is that monetary policy, you have to make a forecast, and then you have to react to the data as they actually come in. And the data as they actually come in are never the forecast. If the sense of your question is, will we get back to 3%? So let me answer that question. So that's sort of the long run. That number is supposed to represent the long run rate of the federal funds rate at a time when the economy is at full employment and inflation's at 2%. And that number would have been 4.25% before the financial crisis. So now, members of the participants on the FOMC have gradually lowered that rate as estimates of potential growth have come down, so they now think it's 3%. So that's much lower than it used to be. Your question really is, one way to think about your question is that learning process done with? And it may not be. It may be that actually 3% is too high. Well, but I would say it's been a learning process for me to realize that interest rates need to be still lower than we had thought, just to keep the economy on an even keel, growing toward 2% and maximum employment.
We have one question all the way in the back, please.
Thank you for taking my question. So to take that a step further, do you believe in PIMCO's Mohammed El-Arian's comment that we'll never see 5% interest rates in our lifetime?
I haven't seen that forecast. I wouldn't. I want neither to disagree with him nor do I want to comment on anybody's other forecast. But no, I mean, it's a fair question, and I assume that's a risk-free rate you're talking about. Of course, you're going to see 5% interest rates in the credit markets. I don't know. I mean, the truth is, economic forecasts out more than a quarter are highly uncertain. Highly uncertain. The error bands, you wouldn't believe. Maybe you do this for a living. You would believe. If you just go back and measure how wrong everyone's forecast is, just everyone, take the best forecasters, and how wrong are they? The error bands are very, very wide. It's not, we don't have the ability to really forecast that. So humility is a job requirement.
Phil, over here in the first row, please.
Thank you. I wanted to follow up on that particular point. Your points were well taken about the big error bands when you try to forecast out very far. When you think about rate decisions, how long are you thinking of as a lag until they kick in? And aren't you then sort of reliant on these forecasts? And how do you incorporate data that's happening now in terms of what will happen a year and a half from now?
So this is it's a kind of a fact about monetary policy that is thought to work with long and variable lags, meaning in the ordinary state of events, you raise interest rates now and that works its way into the economy, or you cut interest rates, it works its way into the economy over a period of 6 to 18 months or something like that. This is, you begin to see maybe it's just not a precise, this is not a surgical kind of a science. But it really in the current environment though, it feels to me anyway like in some respects, financial markets are unusually responsive to changes in financial market beliefs about the path of policy. So it might be now that there are some ways in which, not across the board, but some ways in which it's more responsive. But you have to think of it that way. That's why people say that that interest rates have to go up before the economy gets so tight that it will overshoot and there'll be inflation and that kind of thing. That doesn't seem to me to be the problem we face right now, but that's a fair point in the ordinary course. So it's a good question.
Okay, another question over here in the first row, please.
In the aftermath of the financial crisis, do you believe that policies could have been implemented that would have enabled the Fed not to have had the burden that it has had to deal with it?
The Fed is an agency, I should say. The Fed is an agency created by Congress, and we're not a co-equal branch of government. We're an agency that they created, and they gave us an assignment, which is use interest rates to achieve really financial stability and maximum employment and stable prices. So it doesn't really behoove us to be, to run around criticizing and telling Congress how to do their job. But it is, nonetheless, I would say it's a fact that fiscal policy was historically tight during this period of 2010, 11, and 12. It is now roughly neutral, maybe a little bit. And those are decisions that are given to Congress to make. They get to make that decision, and it's a question of, do you want to take fiscal austerity now? And really, this is not our job. So we take that as a given. And for sure, what that means is that the burden of achieving growth, not just here, but even more so in Europe, frankly, the burden of achieving growth for monetary policy is that much harder. And so that's why, you know, in one sense, that's why central banks have taken such extraordinary measures.
Okay, over here on this side, please.
Going back a few years further than that, and continuing that subject, do you think the Fed showed some analytical failure in appearing to be so surprised by the collapse of the securities based on mortgages that triggered the crisis? And is there any possibility that if there was such a failure then, has it been analyzed by the Fed since then? Is it any possibility that a prejudice or analytical problems remain that are similar to the ones that contributed to that crisis?
Interesting question. So I would say that basically every feature of the financial crisis, every piece of infrastructure that didn't perform or actually broke, and we had to step in, everything that went wrong has been carefully and thoroughly studied and debated. And you know, things like short-term wholesale funding, where all of the financial runs were really what happened in the financial crisis was that the world lost confidence in the funding of the financial system, and there was a giant run on the system. And that's the one thing you can't have, because financial systems operate on confidence, and when confidence is gone, that's what you have. So I think the answer to your question is all of the things that happened have been studied carefully, and measures are being taken, strong measures are being taken to address all of those problems, right? So I don't think we'll make those mistakes the next time. But do I think there won't be a next time? No, I think there probably will, but it'll be different. You know, historically, there have been, you know, financial crises come and go. I think we're a long way from having another one. I think it'll be a long time till anything like that happens again. And when it happens, it'll probably be something quite different. But you could mention any feature of what went wrong, and I can promise you there have been books written and probably very direct measures taken to address. And I think successful ones, by and large successful ones.
Okay, we have one question over there in the aisle, please.
Yeah, following somewhat on that, do you believe that sovereign debt should carry a zero risk weighting? And if you, whatever your answer is, who guarantees the ECB?
So that's a Basel question, and you know it does carry a zero weighting, so it's a fact. And who guarantees the ECB? Well, the ECB is the central bank of the world's largest economic market, and they do print their own currency. So you know, I'm not at all concerned about their creditworthiness.
Okay, we have one question here.
Jay, thanks a lot for your great economic review and outlook. And my 13-year-old daughter, who's a budding economist next to me, has a bunch of questions I've got to answer at dinner about some of the terms. But my question for you is, when Leo was up introducing you, he said one of the things you're working on is repo, like illiquidity in the repo market. What are you trying to, when you do that work, which was, as has been referred to in the financial crisis many times, was a big issue. What are you looking for? How do you analyze what to, you know, what kind of market or circuit breakers to have, or what kind of liquidity the Fed could inject in that? What does that look like? That sounds really interesting to me.
So for those of you who don't live in the financial markets, repo just means a repurchase agreement. Effectively, what it is an overnight loan against a security, typically a very high, you know, low risk security, highly valued low risk security. So an overnight loan where you, instead of only as structured as a purchase and sale. That's what repo is. And the repo markets were one of the principal places where, you know, where there was a run. Frankly, people were lending money. They were financing, for example, the balance sheets of the large broker-dealers overnight in the repo market. And when people lost confidence, they withheld their funding, and then the broker-dealers really, there was no obvious source to finance their balance sheets, and so the Federal Reserve had to step in. So that was a big problem. What's happened is that there have been significant measures enacted. I would say particularly the net stable funding ratio, which really is directly addressed at the financing of repo books, so that they'll be much more stably funded. They won't be these big duration mismatches where you've got overnight funding and a long-term issue. That's one thing. But really so we enact these things, and I would say repo is an area where repo is one of the principal ways that Treasury securities are financed. And a lot of what I've been doing is working on is trying to make sure that the repo markets remain liquid. And central clearing is an important possible answer to lighten some of the regulatory burden that has been appropriately put on repo, keep it safe, but through central clearing you can lighten that burden. And that's, this is the kind of stuff that'll clear out a cocktail party. But
We have one-
very happy to talk about it more.
We have one question over here in the first row, please.
You suggested that the inflation rate has become somewhat decoupled from the economic cycle. Does that have an effect on the way the Federal Reserve does its job to maintain stable prices, or is it likely to in the future?
So the benefit of having strongly anchored inflation expectations, which means that, for example, what it meant in the financial crisis, that all of the models would have suggested that inflation should have turned into deflation because the fall in output was that large and that sharp. But that didn't happen. Inflation actually only moved down a little bit. And then we had a long period where we were in the mid-2000s where we were probably operating above potential growth. The economy was running hot, and again, inflation barely moved up. So what that enables a central bank to do is to lean harder against the business cycle without having to worry about dislodging inflation. That's really what it does, and that's why the inflation targeting regime, which is what most central banks do, it's not precisely what we do because we're a dual mandate bank, but it lets you push harder. When things go bad, you can push much harder without worrying that inflation is going to shoot off to the top. And you can tighten more, frankly, without worrying about inflation going negative. So in the 1970s, when I was in college, inflation expectations were not anchored. So when inflation started to move, it would keep moving. If you remember, it just kept going up and up and up and up and up. That doesn't happen. Thank Paul Volcker, and really for close to 40 years now, inflation has been under control, stable, and I think it's a big part of the story for what we can contribute over the long term is stable prices, but it does play an important role in that respect.
Oh, we have one question here, second row, please.
Just curious, in terms of economic dynamism, what other areas do you suspect could be impacting that outside of government licensing? So I guess I'd say if you could kind of mandate research into 3, 4, or 5 areas that you suspect are really having an impact on economic dynamism, what would those areas be?
I'm not one of the researchers who's doing this. I'm not a researcher, but so I will tell you what they're looking into. So one of them is that there was a wave of state law changes that made it much more difficult to fire employees, and they've found correlation between lower dynamism and difficulty in firing employees. It's harder to fire employees. Maybe you're less likely to hire them. That's certainly the case in a lot of countries where it's impossible to fire employees, and therefore you're really reluctant to hire people full time. So that's a big place where to look. I don't think dynamism is the main part of the story, but it's a new part of the story that's just starting to get discussed more. I think the big part of the story is really that so weak demand leads to a big crisis like this leads to very weak demand. That leads to lower capital expenditures, which itself leads to lower demand. And you're in a bit of a cycle now where we really want productivity to go up, but we're in the shadow of a number of years of weak investment. And productivity is not going to want to go up if after a number of years of very weak, at least that part, the part that's driven by capital investment. is not going to want to go up. Total factor productivity, though, is about technology, and it's about, this is a science that we understand a little bit, but not perfectly yet.
We had a question over on the far end.
You mentioned financial conditions in your speech a few times, and I wonder how those are integrated into the Fed's decision making. And it seems like often, you got a lot of financial conditions tightening without that many rate hikes, and especially in a world where kind of all countries are at the zero lower bound. Even Brexit happens, financial conditions tighten, and maybe that has done the work of hiking for you. Can you kind of explain how you integrate that into your rate hiking decisions?
Sure. So what really matters for the economy is overall financial conditions, right? It's not particularly the federal funds rate. And the reason the federal funds rate is our tool is that over time it has been, right in the middle of that pack, and it has tended to move financial conditions around. But there are other, the reason I would say financial conditions have tightened since the vote is that the dollar is higher, a couple percent higher, equity prices are lower, credit spreads are wider. Those are all just different financial conditions, and if you add them up, they add up to a modest tightening of financial conditions. But it really is broader financial conditions that matter, not so much the federal funds rate. And you're right that financial conditions have tightened significantly in the equivalent of several rate hikes since 2014. Really, particularly through the dollar, a 20% increase in the dollar is a big tightening in financial conditions because it weighs on our manufacturing sector and makes it difficult to export, makes our exports that much more expensive.
Hi, thank you for being here. My question is about stable prices. Does that in any way take into account healthcare costs and tuition rates? Because those seem to be going up by much more than 2%. Thank you.
Yes. So both the PCE inflation, which we, go by, and CPI represent really a basket of goods and services, and it absolutely includes healthcare costs and educational costs and everything. And so there are always things within that basket that are going up in cost way more than 2%, but there are also always things that are frankly declining in cost. So a lot of the technology we all spend money on, you're getting better and better technology for less and less. So if you average it all out on a weighted average basis, what you get is a measure of inflation. And it's not perfect. These are human-created measures. You can do it a whole bunch of different ways. And people there are people who spend their lives thinking of different ways to measure inflation. There's the billion price project. There's trimmed means, almost limitless numbers of ways to calculate it. But there's a lot of science and effort and transparency too in what is in the PCE basket and what is in the CPI basket and what the methodologies are and all of that. So if you really want to see what's in them, it's right there on the web.
All the way in the back, please. There by the aisle.
On the subject of inflation, I believe core inflation for the last few months has been above 2%. In May, it was above 2%. So how do you factor that in to your equation, especially if oil, which is really volatile, a year from now, oil prices could be up, and then the actual CPI would be up a lot. But the last few months of core inflation being up 2%, how do you view that from your inflation fight?
Core inflation over the last 12 months is 1.5%, and yes, it's year over year. So a monthly measure or a couple months of core inflation, it's very volatile month to month. So 1.5%, so you're dragging a 12-month average, which has been lower than 1.5%. It's moved up to 1.5%. Actually, maybe 1.6 now on our latest 12-month basis. You may also be thinking of core CPI, which would be higher too. I'm not sure, but yeah. So that's 50 basis points higher. So we're 1.5, 1.6. I would say the effect of the stronger dollar on import prices could be 25 basis points. So if you're at 1.6, You could add 25 basis points sort of mechanically if the dollar were to remain stable, and you'd be at 1.85. So we're not that far away if you want to pro forma that in. And by the way, oil does leak, lower oil prices leak into core, even though they're not supposed to be included. They leak because oil's an intermediate good for manufacturers. That's probably another tenth. So we're not all that far, but expectations are low, and they're low to the point where it's troubling. And we just have to we've got to get inflation to 2%, and I'm certainly committed to doing that, as I mentioned.
Okay, in the middle over here, please.
Thank you. James L. Hendricks. I just finished a book by Roger Lowenstein, America's Bank. My question is, America's Bank, is that a fair name in light of you take so much in consideration what's going on around the world? There was a mention that the ECB has a bank. There's other central banks. Why do we play such a huge part in monetary policy around the world?
Great question. So why do we care about what's going on around the world? So really only for one reason, and that's to the extent it affects our mandate, which is to try to achieve stable prices and maximum employment here. That we are not, we're focused on the good and well-being of the U.S. economy and U.S. citizens. But in this world, to do that, you've got to, global factors are unusually important right now for the U.S. economy. They really are. So that particularly, look at the strength of the dollar, which is having a real effect on the U.S. economy now. So really, it's not that we are assuming responsibility for others. It's that to carry out our responsibilities, we have to be mindful of and understand and take into consideration what other countries are doing and what's happening around the world. You saw what happened in January and February to our stock market and our, and everything. That was because of something that happened in China. So, appreciate the question.
Far left in the back, please.
Are we witnessing globalization taking a step back or just catching its breath?
So it's really hard to know. It is. Clearly, trade is accounting for a smaller part of growth than it has in a long, long time. It's a good question. I mean, you're seeing pushback against globalization and immigration in various jurisdictions. I mean, we're going to have to let time tell on that one.
Okay, over here, third row, please.
You haven't mentioned the impact of these low interest rates on the elderly, and I wonder if there's been discussion about that. I know many, many people who've been waiting for years now to see any income, and they are hurting badly.
So the answer is yes. I just speak for myself. That's something that anybody who works at the Fed hears all the time and takes into consideration. But let me try to explain it. So we have this one tool, and we have to achieve these objectives with the one tool that we have, which is the interest rate. It isn't going to be good for every single group within society. It has to be good. We have to do the thing that is good for society as a whole. So, and if you actually dig into the numbers, the number of elderly who are actually just living on interest, who don't, for example, own a home. If you own a home, you should like our monetary policy. You should like us. If you own equities, you should like our monetary policy. If you have kids who are unemployed and want jobs, you should like our monetary policy. So if you're really just living on interest, if one is living on interest on a bank account, then yes, you will be, there's no question that low interest rates will hurt you. The last thing I'll say though is the only way for interest rates to go up and stay up to a sustainable level is for the economy to be strong. People think that, if we step back, interest rates would go way up. They wouldn't. If you look at interest rates, look at a 30-year graph of take long-term interest rates, which we don't control. For 30 years, interest rates have been going like that, and they're now as low as they've been really ever. So it's not just us. These are global forces that are driving these rates down. But anyway, it's a very fair question.
Okay, second row here, please.
Governor Powell, you focused on low business investment as perhaps one of the causes of the downturn in productivity. If you went to the business community and asked business people, why do you think you're not investing? You might hear, I don't know this for a fact, that government fiscal policy spending is a little bit misdirected, and the tax regime is not pro-growth, and we're drowning in regulation. I know the Fed tries not to get too far into the political arena, but what about some research that maybe looked at those three factors, and maybe that could be something Congress might consider then?
No, we do. We don't want to. We want to stick to our knitting and not get into one of the things I love about the Fed that it is really so nonpartisan, and you're inside the four walls. Nobody has a party label. It's that simple, and we just don't talk about politics. So, but I think what you mostly hear is demand. I mean, I have a lot of business context from my career as a private equity investor, and what you mostly hear is I don't have to invest, and also people are you can hire. Hiring's been good. You can, in this jurisdiction, in the United States, you can hire people, doesn't work out, you can let them go. Why build a building? Once you build a building or that sort of thing, it's a different thing. So, but look, on regulation generally, I'll just say, regulation needs to be smart. The financial sector needed to be better regulated, and we're still working on that. But regulation needs to be pro-growth. It needs to do its job without interfering with growth and unnecessarily, let's say. So I'd certainly agree with that.
Okay, over here, please.
Thank you. As an instrument of monetary policy, has the Fed considered a cancellation of treaties owned at some slow and publicized rate as a stimulating tool now that the lower bound of interest rates has been reached?
Sorry, have we considered what?
The cancellation of treasuries.
Of treasuries?
Yes.
Sorry. No, we have not. The U.S. is the Treasury is sacrosanct, and it's not something we would consider.
Okay, and we have time for one more question. Over here, first row, please.
How concerned are you about deflation as a long-term issue? And if so, what tools does the Fed have to address that?
For me, it's not so much deflation. And again, I think in terms of probabilities, right? So the case that I worry about is, and it's not my main expectation, but the case that I would worry about is a longer period of low inflation and low growth and low interest rates, which is bad across a range of things. That makes fiscal policies much harder. It makes monetary policy much less effective because we can't achieve negative rates because of the zero lower bound and inflation with inflation so low. So that's the case that I really worry about. And so that's one of the reasons why I think we need to keep pushing. We've made a lot of progress, but the recovery is not to be taken for granted. And I think we're making progress. We've had 7 years now. We're 2 days away from the 7th birthday of the recovery, and June 30th, 2009. And if we can make just a few more years of progress at this rate, where you're admittedly slow growth, but 2% inflation and the labor market tightening, it feels a lot better than it felt in 2012 and 13. I want to keep that up. Deflation itself, as long as inflation expectations remain stable and anchored, it shouldn't be an issue. I mean, if we were going to see deflation, we should have seen it right after the financial crisis, when the models that might have predicted that. But now, I think our inflation expectations are anchored, and then we won't have deflation, and I think that's why we've got to be sure that we keep them anchored.
Thank you, Governor Powell. That's all the time we have. Take that very much.
My pleasure. Thanks, Sebastian.
Thank you.